let's talk about some common mistakes that managers and employees might fall victim to. The first has to do with sunk costs. There is a tendency to overweight that which has occurred in the past and or that which cannot be changed. And in this case, not only is the sunk cost irrelevant to the decision, but considering it might lead to a poor decision. Another example relates to fixed costs, and there are two aspects to these common mistakes. The first is sometimes how accounting information is presented to managers and employees. In certain reports, fixed costs are provided on a per unit basis. Under some approaches, they're divided by some activity measure and assigned to the units of product. In essence, they appear variable and are deemed more important than they really are. Another way in which fixed costs can lead to common mistakes is that in the concept of allocated fixed cost. A possible result is that a product or department may actually appear unprofitable as a function of the allocation method chosen. This means that the fixed cost that the firm incurs as a whole is shared across all of the business units, and it can make some business units look less profitable than they really are. If they were to eliminate that business unit, the fixed cost would not be saved, they would just be put back into the pool and allocated to the remaining business units. And finally, another common mistake has to do with opportunity costs. People tend to overlook opportunity costs or to treat them as less important than the more salient out-of-pocket costs. So in the coming examples, we'll talk about how managers and employees might fall victim to these common mistakes and use relevant information to overcome these common obstacles.